Hello everyone and welcome to Managerial Accounting. In this video we're going to be going over chapter 25, which is about differential analysis and something called product pricing. So let's talk about differential analysis. What is meant by differential analysis? So sometimes we call it incremental analysis, and it's basically it analyzes the difference between revenue and cost in order to determine the differential impact on profit of two alternative courses of action. So basically in differential analysis we're comparing between two options. That's the main thing. And we have to keep in mind the revenues and the cost so we can see the net impact on profit. So we have to think about differential revenue, differential cost, and that would lead to differential profit. Let's go into an example so we can have a better understanding of how we can use differential analysis. So assume that on July 11, Bryant Restaurants is deciding whether to replace some of its customer seating and tables with a salad bar. So we have like in a restaurant they have like tables with like it's used for customer seating. They want to replace few of them with a salad bar. So, and here we have like some kind of differential analysis to see the two alternatives. So the first alternative here where we have, we'll keep the tables, that would generate a revenue of $100,000, and let's say that's per year, and the cost per year would be about $60,000. So the profit would be the difference, which is $40,000. That if we decided to keep the tables. But if we decided to replace them with salad bar, which is the second alternative, the revenues would increase to $120,000. The cost would also increase, it would be $65,000. So the profit would be $55,000. So just by looking at the two alternatives, I think you can see that alternative 2 would lead to a higher profit. But we have to do the differential effect. So by just getting the difference between alternative 2 and alternative 1. So 120 minus 100, that's $20,000. And then the cost also increased by $5,000. So since cost is a minus, we subtract it from the revenues here, $20,000. And then we see the difference, which is a profit of $15,000. That's a positive difference, so towards the salad bar. So it seems like a salad bar would be a better option. So the differential revenue of a salad bar over tables is $20,000. The cost difference is $5,000. The differential profit is $15,000. And you can see here how we present it, which is basically similar to this differential analysis here. So we got the differential revenue, differential cost to get the differential profit of the salad bar. So based upon the differential analysis, Bryant Restaurants should decide to replace some of its tables with a salad bar. Because of doing so, they will increase its profit and income by $15,000. Let's see another situation where we can use differential analysis, which is the option or the alternatives of leasing or selling. So let's say we have an asset, we want to decide, should we sell it or should we lease it or rent it out? So management may lease or sell a piece of equipment that is no longer needed, and differential analysis can help them make a decision. So assume that on June 22nd of the current year, a company called Marcus is considering leasing or selling the following equipment. So Marcus Company is considering leasing or selling the following equipment. The cost of the equipment is $200,000. Their accumulated depreciation is $120,000, so the book value or the remaining value is $80,000. So the first alternative is to lease out this equipment. And if they leased it out, then there would be a total revenue for a 5-year period of $160,000. So if we basically divide the 160 by 5, I think it would be about $32,000 per year. And as a total for the 5 years, it's going to be $160,000. The total estimated repairs, insurance, and property tax expenses during the life of the lease is about $35,000 over the 5 years. The residual value at the end of 5 years of the lease is 0. So the book value of the asset is going to be 0. The second alternative is to sell it right now. and the selling price would be $100,000, and there's a commission on sales of 6%, which is about $6,000. So let's do the differential analysis to see whether the lease or the sell would be a better option for this kind of equipment that we do not use it anymore. So the first alternative here, you can see we have the lease equipment or to lease the equipment, and the second alternative is to sell it. Again, remember, we always have to use the revenue, cost, and the profit. So the revenue would be 160 over 5 years under the lease option. The cost would be $35,000, and the profit would be $125,000, which is the difference between this 160 and 35. Selling the equipment, we can sell it for $100,000. That's our revenue. There's a commission fee that we have to pay, which is our cost here, would be $6,000, and the net profit would be $94,000. Again, by just comparing alternative 1 and 2, you can see that the lease option would be more profitable. But also looking at the differential effect, you can see that there's a difference of $60,000, or a decline by $60,000 if we decided to sell it. However, our cost is going to be improved by $29,000. So you see here, this is a positive value. And then the profit, actually in this case it would be a loss because the residual will be a negative value. So $31,000 is a loss in case we decided to sell the equipment instead of leasing it. So again, as a matter of fact, you can see that the leasing option is a better option. So the equipment is sold. If the equipment is sold, differential revenue would decrease by $60,000, differential cost would decrease by $29,000, and the differential effect on profit and income is a decrease of $31,000. So the decision should be to lease it instead of selling it. Only the differential revenue and differential costs associated with the lease or sell decision should be considered in the differential analysis. I don't know if you noticed, but we totally ignored this top value here, the cost of the equipment, its accumulated depreciation, and the book value. Why we ignored it? Because this is called sunk cost. So sunk costs are the costs that have been incurred in the past, cannot be recouped, and are not relevant to future decisions. So for Marcus' company, the $80,000 book value of the equipment is a sunk cost and is not considered in the decision. Let's see another example for two alternatives, whether we should discontinue a segment or a product, or keep it. So, or actually, we have like different segments, and we want to decide which segment we should keep it or discontinue it. So management may consider discontinuing or eliminating a product or segment that is generating losses. So if we ever have a section or a division that's creating some losses over the years, then many companies might consider discontinuing that product or segment or eliminating it. Might appear that this is the best decision. However, we have to keep in mind that there might be some fixed costs that we cannot get rid of if we eliminate this product or segment. So discontinuing the product or segment usually eliminates all the product or the segment's variable costs, such as direct material, direct labor, variable factory overhead, and sales commission. However, the fixed costs, such as depreciation, insurance, and property taxes, may not be eliminated. Therefore, if it is possible for total company income to decrease rather than increase if the unprofitable product or segment is discontinued. So the income statement, let's see this example. Assume that the income statement for Battle Creek Cereal Company is shown in Exhibit 3 here in this exhibit. You see here they have 3 products or 3 segments: corn flakes, toasted oats, and bran flakes. And you can see that the bran flakes is the one that has an operating loss. So management is considering getting rid of that or discontinuing the bran flakes division. So the income statement is showing that the bran flakes product line incurred an operating loss of $11,000. Because bran flakes has incurred annual losses for several years, management is considering discontinuing it. So the question is, should we discontinue it or not? Notice that there are fixed costs that's related to the cost of goods sold, and there's also fixed expenses and operating expenses. These two costs and expenses are not going to be eliminated if the company decided to discontinue the brand flags. So in the next exhibit, which is exhibit 4 here, discontinuing brand flags alternative 2 actually decreases profit and operating income by $15,000, even though it incurs a net loss of $11,000, which is because this discontinuing brand flags has no effect on fixed cost and expenses. So let's try to understand that more. So here we have the two options: continue the brand flags, which is the losing division, or discontinuing it. That's the second alternative. So if we decided to continue, the revenue would be $100,000. They have two kind of costs, $85,000 and for variable cost and $26,000 for the fixed cost. So that for a total of $111,000. Subtracting the cost from the revenue, that would give us a loss of $11,000. However, if we discontinue the brand flags division, revenue is going to go to zero. The variable cost is going to be eliminated. It's also zero, but the fixed cost would still continue. So we'll end up having a loss of $26,000. Again, looking at these two options, or two alternatives, you can tell that it's better to continue the brand flags, even though it's as a division it's losing. So revenue would go down by $100,000 if we decided to discontinue it. Variable cost is going to go down by $85,000. The fixed cost is going to be the same, so there's no differential effect, and then the profit is going to go down by $15,000. That's why discontinuing this division is not going to be a smart thing to do. Another differential analysis is the decision to make or buy a product. So companies often manufacture products made up of components that are assembled into a final product. And in such cases, the manufacturer must decide whether to make a product or purchase it from a supplier. So many businesses, they have this option. Should we manufacture a product that we actually sell it, or should we just get it from a supplier? So differential analysis can be very helpful in this kind of decision. So let's see an example. Assume that an automobile manufacturer has been purchasing instrument panels for $240 a unit. The factory is currently operating at 80% of its capacity, and no major increase in production is expected in the near future. So the cost per unit of manufacturing an instrument panel internally is as follows. You can see here we have the direct material, direct labor, variable overhead, and fixed factory overhead. One thing I want you to notice that this fixed factory overhead is not going to go away if we decided to buy the panels or the instrument panel from a supplier. We'll still have to pay the fixed factory overhead. However, if we decided to buy it from a supplier, then only the direct material, labor, and the variable overhead are the costs that are going to be reduced. So let's do a differential analysis to see the two alternatives and which one would be more profitable, to make it or to buy it. So alternative one here is to make the panels, and you see here the cost. The revenue is not going to be a factor because whether we buy it or make it, the revenue is going to be the same. So let's only focus on the cost. So the purchase price, if we decided to make it, would be zero. There's no purchase price. The direct material would be 80, direct labor is 80, factory overhead is 52, and the fixed factory overhead is 68. So that would give us a total unit cost of 280. So that's how the cost is if we decided to make it. Don't compare the 280 to the 240, which is the purchasing price from the suppliers. Why? Because there's actually a fixed cost that has to be added to the purchase price in case of buying it from a supplier. So under alternative 2, the purchase price is 240. direct material, labor, and overhead, variable factory overhead, all of these are zeros because we are buying it, we're not manufacturing it. But the fixed factory overhead is never going to go away. That's a fixed cost, we're going to incur it anyway. So adding these together, you can see that the total cost now went up to 308. Looking at comparison between alternative 1 and 2, you see that buying the panels is going to cost more, $308 versus $280. So the differential effect, again, you can see here the purchase price, if we decided to make the panel, would be lower by $240. The direct material, direct labor are going to increase by $80. The variable factory overhead is going to increase by $52. However, the fixed factory overhead is going to stay the same, which is that's why the differential effect is 0. If we add these numbers here, we can see that the total unit cost is going to be lower by $28 if we decided to make it ourselves. So, if the make price of $280 is simply compared with the buy price of $240, remember, don't do that because you're ignoring the fixed cost. But in this case, the decision is to buy the instrument panel. However, unused capacity could be used in manufacturing the part. Only the variable factory overhead cost would increase. Revenue is not affected by this decision, and the fixed factory overhead cannot be eliminated by purchasing the panel. So as I mentioned, revenue is not part of the model in this case. And as I mentioned, the fixed factory overhead cannot be eliminated if we decided to buy the panels from suppliers. So the differential analysis indicates there's a loss of 28 per unit from buying the instrument panel. Therefore, the instrument panel should be manufactured. There are a few things that companies should consider because they might have some indirect impact. So things like productive capacity used to make the instrument panel would not be available for other production. So let's say we got another sales order, so we will not be able to satisfy that because we have already used our extra capacity in manufacturing the instruments. Another thing that we have to keep in mind is that future businesses' relationship with the instrument panel supplier may be affected if we decide to manufacture ourselves instead of buying it. So all of these are things to keep in mind, but at the end of the day, if we're looking at the numbers, we're comparing the numbers, then the differential analysis is our basis for the comparison. So let me stop here. In the next video, we're going to be talking about another topic, which is replacing equipment.